Hello guys and welcome to the channel. If you are new to the channel, my name is Farah, hence the name just Farah. Okay, that's just a simple intro. So this episode is for beginners as well as those advanced traders who wish to enhance their knowledge. So before this episode ends or after this episode ends, you'll be able to know this. Okay, what is forex trading, why you should trade forex, who and when can you trade the forex industry, what is current pairs, what is bid ask spread, what is bullish and bearish markets, what are lot sizes, going short, going long, what are pending orders, what is leverage and margin. Okay, so you'll be able to know these things with a deep down critical analysis, right? So I said before this video ends or after it ends, it depends with how much you understand information or how much your brain analyzes information. So here is the first thing, right? So on this page, I'm actually going to talk about why you should definitely trade the forex industry. As you can see here, the first point is accessibility, right? Getting started on the foreign exchange market is one of the easiest things to do. With a little capital from as little as $10 and of course trading knowledge, you can start buying and selling currencies online. Some other requirements include an internet connection as well as the gadgets to carry out your transactions on, right? Then the second reason why you should definitely try this forex thing is that it has high volume and high liquidity. Okay, with a lot of people participating and huge sums of money being pumped into the system, this industry offers high movements and volatility, which means that being profitable is a great probability, right? So you can actually see that a lot of people are actually shifting to the forex industry, hence there is high liquidity. The market is actually moving here and there, right? We're talking about volatility here. We'll definitely talk about that more. Then within the forex industry, there's good leverage compared to the other industries, right? Let's talk about leverage. So with leverage, one can open positions bigger than his or her account size. This is one of the reasons why now we as retail traders can now participate on the $1 trillion market with $10 or even less, right? This industry offers very much better leverage options compared to the stock exchange, which in most cases offers it at 1:2. Okay, so the stock exchange doesn't offer that crazy leverage, right? So high leverage offered by the forex market may enable a trader, right, to make good money with a small capital invested, but it can take sour if everything goes against you. So we definitely talk about and document this leverage thing, right? So in the forex industry, the fourth reason why you should definitely shift into the forex industry, that is all about buying and selling, right? So it's either of the two options, right? When you see an appreciation of price, all it takes is a simple click of the buy icon, then vice versa for sales, right? You see, it's only buying and selling in the industry, but it's more than that. We'll definitely talk about that. I don't want to scare you right now because you'll be scared and you say this guy does this and that. So the forex market is actually 24/7, right? Which means you can actually trade it on a daily basis, right? Excluding the weekends, obviously, because it's 5 days a week, right? Then you have to treat, that's why you have to definitely treat this one as a business, because you definitely see that you'll be working 5 days a week, right? So this is all about the reasons why you should definitely start trading, right? Then we are moving. I hope you are liking what you're seeing right here, right? So let's shift it to here, right? Ding, 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 ding. Okay, so we are talking about who and when can you trade the foreign exchange market, right? So anyone who is just 18 years and above can participate in this industry. Also, this includes hedge fund managers, banks, right? These banks are actually believed to be inducing movements in the market, right? We'll talk about that. They're also called market makers, right? So the time zones in the forex industry are what we are talking about right now. So the market is open 24 hours, as we said, right? Then 5 days a week. But this does not necessarily mean that this industry is volatile all the time, right? You see, so there are certain time zones the industry is believed to be where the highest volumes and liquidity is dumped from, and these include the Sydney, which is like the time for the time zone, right? Then the Tokyo time zone, then the London time zone, right? Or London session, then the New York session, right? So what you see on the right of the screen here is the time zones, right? And they are expressed in GMT, right? Which is the green mean time, right, guys? You don't have to confuse this. I said the green mean time. You don't have to be out there lying to people. So as you can actually see right here, from 8 o'clock a.m. to 3 o'clock, right? We are talking about the GMT. We have got the London session where people in London are actually dropping their crazy ass monies. Then we have got the New York session from 1 o'clock to 9 o'clock. Then we have the Sydney session from 8 o'clock to 4 o'clock. Then the Tokyo session from 12 o'clock to 4 o'clock, right? You can actually see that at certain points in time, these sessions are actually crossing each other. Then we'll definitely talk about that. Again, I don't want to confuse you, because I know you'll be confused and say this guy say this and that and that. So let's now move to current pairs, right? I want to explain this. So whenever you open your trading platform such as MetaTrader, we'll definitely talk about that, you may see something written as EUR USD and you wonder as to what that will be. That is simply two currencies pegged together, as you see, and continue with this course. Whenever you trade Forex, right, I'm here, you have to read in line with me. So whenever you trade Forex, you have to trade one currency against the other, hence you see them in pairs. Once you see these currencies in pairs, note that we have what is termed the base currency, then the quote currency. The base currency is the one that is written on the left, starting one, right? Okay, the brackets actually indicate that it's actually the starting pair, the starting currency between the two. Then there is what we call the quote currency, which is the one on the right. Look at this. Okay, I'm referring to this, what is in the brackets, which is written EUR USD. Here, the EUR, which is the euro, is the base currency. Then the USD, which is the quote currency, right, is written USD. This naming of currencies with symbols such as EUR is the international symbol naming, right? And each currency has its own code. We have three types of currency pairs. Okay, let's rest here. Let's rest here. We are humans. We need to take a break, isn't it? So let's do this. So we have got what we call major currency pairs, right? So these pairs are the mostly active and can provide those great volatile movements many a times. And they include the EUR USD, which is the Euro USD, then the USD JPY, which is the United States, and the Japanese yen. Then we've got the Great Britain pound and USD, the United States dollar and the Swiss franc, the Australian dollar and USD. Okay, so these here are some of the major currency pairs. Then we've got what we call the minor currency pairs. So these pairs are those that do not include the USD, but they do include one of the major currency pairs. Sorry, one of the major currencies, right? So you can actually see that the euro is a minor pair when it is combined to something which is not the USD, the JPY, the GBP, the Swiss franc, the Australian dollar, New Zealand dollar, then the Canadian dollar. So we have the third type of pairs, which is the exotic currency pairs, right? So these are some of the emerging markets and they do not provide much liquidity and volatility. One of the examples of the exotic currency is the United States and the SDG. Okay, let's now shift to a chart that I want to talk about. So as you can see right here, we have got what is written Euro USD. You can actually see that the EUR, which is the euro here, is the best currency, right? Then the USD is the quote currency as stated in between this statement, right? So let's now shift to another part of the segment. So right now we're talking about the bid and ask spread, right? Let me shift to the left and explain dearly so that you guys can understand. So you can actually see that it's written what is bid to ask spread, right? So the bid price is the highest price a buyer may be willing to buy a certain number of shares, right, at a certain point in time. So you wait for the graph to go down, then you buy like crazy. Then the ask price is the lowest price at which a seller may be willing to sell a certain number of shares at a certain point in time. Please, I hope you're reading in line with me. So you see as we proceed that the bid price will almost always be lower than that of the ask price, right? So as I'll proceed with this one, I will definitely eradicate the terms bid and ask price and use the terms buying price and selling price for an easier understanding. So I'm actually going to remove those bid to ask prices and I'm actually going to use the buying and selling price, right? So that we understand. I want you guys to understand this in a simple and straightforward manner, right? So whenever you trade two currencies, you will realize that there are two figures as shown and as I will explain on the right of the screen. So let's take a look at this one before we can actually shift to the chart. So the spread, right? This is the difference between the selling price and the buying price. So this is the money that the broker makes when you transact. So every time you transact, you can actually see that your trade in most cases will definitely start in a loss depending on the account type that you have. We definitely talk about account type. You don't have to rush this process. So let's shift to here and I want to explain right here. Let me zoom out. So you can actually see that we are talking about the base currency, then the quote currency, right? So you can actually see we have the buying price, then the selling price here. Let's explain, because whenever you open a trading platform, you definitely see two numbers written like this, right? then the pairs will be written on the left side. So according to this one, I'm actually giving you this example. So at one time you need 20 worth ZAR, right, to get 1 unit worth USD. I'm talking about this example here. So at one time you need 20, right? Like you need 20 rands to get 1 unit worth of USD. And if you have USD and you want ZAR, you'll be given 17 for every 1 unit of USD you have. So this example is quite self-explanatory. So right now I'm actually going to dig deeper right on this one. So if you transact at that one time, it will be definitely a loss to you. So you wait for price movements in your predicted direction for you to profit. So this forex thing is actually simultaneous, which means that it is done simultaneously. Whenever you buy, you'll be selling at the same time. I will talk about whenever you're selling, you are buying at the same time. Thus, whenever you transact at the same point in time and close your position, you make a profit. So you wait for price movements for you to get that profit and get that dollar into your pocket. So let's move to here. Right, did I skip something? No, I didn't skip anything here. Let's talk about here. I'm actually following the course outline that I posted on the beginning of this episode. So let's shift to here. So here we've got what is written: bullish markets and bearish markets. So these are the two types of markets that we have, considering that we are putting range markets to an exception. So these two terms refers to the overall structure of the market, whether there is value appreciation or value depreciation of the currencies. So this simply means that, okay, I want you to read in line with me. So I'm here right now. So this simply means that the bullish market consists of price movements to the upside, while the bearish market involves price moving downwards. So when you are talking about the bullish market, we are price going up, then bullish or bearish market, I'm actually going to put in red. We're having a market that is going downside. That is what is being said, or that is being meant by this statement. So I want to explain here. So a bull market means that there's too much optimism in the economy and everything looks great. That is gross domestic product, e.g. growing, then employment is increased, and the liquid prices of things, rising. While this is complete opposite of the bearish market. So on bearish market, we have got pessimists, while on the bullish market, we have got the optimists. Then I'm actually going to talk about the reasons why this information matter, the one that I talked about here on the top. So the foreign exchange market is done in pairs. Hence, if one currency is losing value, it definitely means that the other one is appreciating in value. Thereby, with that information, you can take advantage of rising and falling markets. Then you are given the allowance to make better trading decisions. So information, also this news information is important to you to know whether something is happening or something is not happening, right? So as I stated earlier, we've got an ideal bullish market going up, then an ideal bearish market, price is actually going down. We have got too many pessimists in the market or the bearish market. So we are right now here. Let me explain what this all means. I don't know what is happening to my screen here, but I hope I'm going to correct that in 2 years time. Just kidding. So here we are right here. I want to talk about what lot sizes are, right? So lots are those units used to measure the amount in the deal, right? The value of the trade that you open will always have a corresponding relationship to that of the number of lots. So if you open a 0.1 lot, it definitely means that your price movements will be moving in 0.1 units. So using correct lot sizing always have a positive impact on your account, and the position size actually refers to how many of those lots you take on a particular trade, right? So we are here right now. So the standard lot is said to be 100,000 units of the base currency in a trade. So you see how important the base currency is, and now everything has gone in the correct direction. So okay, let me remove this. Don't have to know this crazy information bullshit. So we are talking about here going long and going short in the forex market. So whenever you place a trade or whenever you buy or purchase a certain currency pair, it definitely means that you have definitely gone long, right? I mean long instead of wrong. Don't worry about my English. And whenever you buy, as I stated here, the best currency is being purchased while the quote currency is being sold. So I stated on the previous page, right, that this process is actually happening simultaneously, right? Okay, remember this. Okay, So for example, with the pair euro USD, and you think the EUR is going to appreciate in value against the USD, you would buy the euro and sell the United States dollar. So this is obviously vice versa for the short position, right? Yeah, these are just crazy candlesticks. I love candlesticks. Let's shift again. We are now here, right? So let's talk about these pending orders, right? Let me shift to here. Let me move slightly a bit, right? Let me, this page is troublesome. So a pending order is any trade that is not yet executed. So whenever you don't want to execute a trade at a certain point in time, you put a pending order. So right, so as stated here, the trade will definitely be executed automatically when certain conditions are met. So this is important in that an investor might get away from his or her on screen after putting his or her analysis and gives them leverage to do other things. So this is important. Pending orders are important. We have learned that. So we have these types of pending orders that are actually explained down below. There are many others depending on the broker that you use. These brokers are crazy, I'm telling you. So a buy limit, right? We are actually going to first talk about the buy limit. So if a trader wants to buy a certain commodity below the current market price, then this is an ideal order to be executed. We have also a buy stop. This is when a trader wants to purchase a certain commodity just above the current market price, right? You see what is actually being said. So I will definitely explain with graphs, right? With drawings and stuff. So we've got the sell limit. This is when a trader wants to sell a commodity on a price that is higher than the current market price. Then we've got the sell stop. This order is used when a trader wants to sell a commodity at a price that is lower than the current market price. This is self-explanatory as you always. So let's talk about this. What you're seeing right here is a buy limit. So you can actually see that the current price of the market is here. Then you put your buy limit just below the price, right? Self-explanatory as usual. So we have got a buy stop here. So you can actually see that the current market price is right above here. Is right below the buy stop. So once the market moves to the buy stop, your position will be triggered, and you now have something that is actually going on. So we are now here, right? So on this one, you have to read on your own. I don't want to read for you. You'll be lazy if I do that. Let me zoom here. Okay, now you can read. So for the next 40 seconds, I'm actually giving you the time to subscribe to the channel. Read for yourself. What is leverage? What is margin? Now you're reading. I hope so. Thank you.